Okay, the next item on our agenda is the Human Capital Management Update. And for this, we will ask Ms. Ann Simpson, Interim Managing Director, to come forward, who will moderate a discussion on recent developments in the human capital management. Ms. Simpson, are you there with your panelists?
Thank you, Mr. Jones. Well, good morning to our CalPERS board and all of those listening. It's a great pleasure this morning to be able to moderate this panel on human capital management. This is becoming an issue which is increasingly recognized as important for investors. CalPERS adopted investment beliefs in 2013 following a review of academic evidence on issues which were material, both on risk and return for long-term asset owners like ours. One of the results of that review of evidence in our investment beliefs was the board adopting a statement that long-term value creation requires the effective management of three forms of capital: financial capital, human capital, and physical capital. In other words, we've embedded our understanding of human capital management at the highest level in CalPERS investment beliefs. Following the adoption of the beliefs, CalPERS then developed a strategic plan. And the strategic plan on sustainable investment was adopted by the board in 2016. And this highlighted priorities, areas of work where CalPERS had reviewed the research and saw that as long-term fiduciaries, we had an ability to have an impact in a way that was going to benefit our members and our ability to protect their assets. On human capital management, the focus of that work was on board diversity. And you've had reports in recent months which have shown the impact of that engagement. The other channel in our strategy as a complement to engagement is advocacy. And CalPERS has been vocal in the need for companies to report what is relevant for investors in the field of human capital management. And again, we've seen important progress. The chair of the SEC, Jay Clayton, has made a statement in recent months acknowledging that human capital management is increasingly important for companies and increasingly important for investors because it's a source of value. That puts a focus on the need for disclosure, and much of our work at the SEC through the Investor Advisory Committee has focused on the need for disclosure. Without that, the market is not in a position to understand what's happening with companies, and for an investor like us with a large portfolio, we're not in a position either to compare over time or between companies in the same sector. Again, the Investor Advisory Committee made a set of detailed recommendations to the SEC, and we're hopeful that these recommendations will result in new advice on disclosure in due course. Finally, CalPERS, in its strategy, has engagement. Integration is the next. Integration is where we take what we understand about human capital management and reflect on this and integrate it into our investment decision-making processes. And again, the board is familiar with important initiatives in the investment office which have been helping us make progress in this arena. Our biennial survey of diversity with external managers is an important component. Our continuing commitment to the Emerging Manager Program, which is making available capital for new investors that are coming into the scene in the financial markets, and the recent announcement by our own Chief Executive of CalPERS' first executive level Chief Diversity Officer. So across our strategy for sustainable investment, we have an understanding of the importance of human capital management. I think it's fair to say that we see a growing understanding of this issue, certainly among other investors, in the research and also on the regulatory front. So this morning, I'm very pleased that we'll be welcoming 4 speakers to share their experience and their insights with the CalPERS board on the question of investment strategy with human capital management to the fore. Our first speaker is an employee who's been working at a large company, Amazon, I'm sure you are all familiar with, Hannah Thea. She's a software engineer, and we thought in this panel it would be appropriate for us to begin with a voice and an experience from employees. Our second speaker is going to revisit the research. Everything that CalPERS does is from a fiduciary perspective, and therefore it's vitally important that the work that we pursue is based on evidence. And we'll be hearing from Professor Anthony Hesketh, who's a leading academic in the field of studying human capital management. And he'll be assessing what companies are currently disclosing and seeing how that helps us better understand the sources of corporate performance. We'll then be hearing from Cambria Allen, who is the leader of the Human Capital Management Coalition, to give us a perspective from our fellow investors. We're seeing this issue being raised in company engagement, also in proxy votes, shareholder proposals, and more. So Cambria will be able to share her experience from that coalition, of which CalPERS is a member and has been from the start. And our fourth speaker will give us a perspective from the business community. Ashley will be giving us an insight from the National Association of Corporate Directors. It was important to see in the recent concerns about death of George Floyd, the NACD stepped forward with a statement highlighting the role of boards in addressing issues such as racism. And the NACD is building out a suite of resources for corporate boards, which are no doubt going to be a great resource. So with that as the overview for this session, let me turn to Hannah Thea. We're extremely grateful for her joining us to share her experience from Amazon. Hannah is a software engineer who's been working on the webpage section of the business at Amazon. She's also been a leading force with a group called Discotech, which has been raising the issue of diversity in the technology industry. Hannah has got experience to share as an employee, but also she was the proponent of a shareholder proposal at Amazon, this annual general meeting. That proposal was asking the company to report on issues of gender and race equity in the company. And it was a proposal that CalPERS supported. So Hannah, if we can ask for you to join us and share your experience and insight into the issue of human capital management. Thank you.
Thanks, Anne. I'd like to talk about fungibility at Amazon. Amazon leadership often refers to engineers as fungible, as interchangeable and indistinguishable. We are referred to as resources. Our output is estimated in man-hours. And it's not just engineers. Warehouse workers are resources. Delivery drivers are resources. Communities of color are resources. Amazon is a machine for making more Amazon, and these resources power the machine. It wouldn't even be upset about being referred to as mechanical. It's big on mechanisms, but perhaps it should be. I was a late bloomer. My dad was a programmer. My brother studied computer science in high school, but I didn't realize this career was an option for me until late in my undergraduate studies. It turns out I'm good at it, but I would never say that at work. Self-promotion does not come naturally to me, and in my experience, it isn't well received from women. The Amazon leadership principles, disagree and commit, bias for action, deliver results, define the culture and the only path to success at Amazon, and they reflect the behaviors and biases of its leadership. It is no surprise that white men hold the vast majority of high-level positions in Amazon. Jeff Bezos has more men named Jeff directly reporting to him than women.
Time and again, I have been made to feel that I am invisible. whether it be getting opportunities to lead a project, providing opinions in a meeting, or during my promotion process. I was told that I'm already operating at the next level in terms of the technical bar required. But the only thing holding my promotion back is that I'm too quiet, and the process needs me to be more outspoken and assertive. While my manager acknowledged that the system was broken, I did not see any efforts to change this broken system. And after giving 3 years of what I could, I decided to leave the team.
Amazon is clear it wants its employees to fit in a box. The innkeeper Procrustes from Greek mythology offered a bed to weary travelers on their trek from Eleusis to Athens. If the traveler did not fit the length of the bed, Procrustes would hammer and stretch them into its frame. If they were too tall, out came the hatchet. The woman in that clip has left the company, discouraged by not being able to be her full self and still succeed at Amazon. I also left. July 3rd was my last day there as an engineer. I did not want to spend more of my life being stretched and chopped to fit. I did not want to spend more of my life being a resource to build more Amazon. I never felt that I could succeed due to my strengths, but only to the degree that I modeled the ideal Amazon behaviors. Now, a week shy of my 30th birthday, I feel like I can finally start to find the parts of me that I lost while working there. Despite that, I know I am very privileged. I am white. Amazon has paid me well and has set me up for a comfortable future. I was able to make the choice to leave the company. While Amazon rhetoric refers to engineers as fungible, there is no one it treats as more fungible than its warehouse workers and the communities of color in which warehouses are typically sited. These are the resources that are hurt most as Amazon makes more Amazon. Amazon comes into these communities without their consent. It was particularly interesting to watch it call for bids for its HQ2, perhaps to learn about the tax concessions each city would be willing to make. All with the promise that Amazon will bring more jobs, will boost the economy. The communities where Amazon is already prevalent tell a different story. The introduction of Amazon to the predominantly Latinx Inland Empire, the logistics hub in Southern California, came with the promise to pull people out of the 2008 recession. Instead, workers report that the quotas against which they are measured make for a grueling and unsustainable pace. They look around and see other warehouses paying better and rewarding people for their on-the-job performance instead of punishing them. They also look around and see some of the worst pollution in the country. The area has twice the national rate of asthma, putting residents at a higher risk for severe illness from COVID-19. Procrustes' house was along the main road to Athens. His hospitality to his guests ultimately killed the travelers that had no choice but to spend the night. As Alana Samuels put it in The Atlantic, for many places, the choice is not between Amazon or another better employer. The choice instead is Amazon or nothing. COVID-19 has especially highlighted the ways that Amazon sees humans as fungible, disposable resources. In a live stream set up by Amazon Employees for Climate Justice, AECJ, we heard from warehouse workers who had to demand that the company tell them when someone at their warehouse tests positive for the virus. We all got to see leaked notes taken by David Sapolsky, Amazon's general counsel, from an executive level meeting where it was suggested that Black warehouse worker Chris Smalls was not smart or articulate, and that they could make him the face of the organizing movement. Smalls had recently been fired after organizing a strike about COVID-19 protections at his Staten Island warehouse. That leaked memo says Amazon's focus is to protect workers. Despite record-breaking cases in the US, their actions suggest that it's back to business as usual. In April, they eliminated the option of taking unlimited, unpaid time off for those who felt unsafe coming into work during the pandemic. At the beginning of June, they dropped their COVID-19 $2 hazard pay. At the end of June, another leaked memo showed warehouses with infection rates from 4 to 17 times that of surrounding counties. Many of these issues have been highlighted in recent years by employee and community organizers. AECJ and Discotech have put forth shareholder resolutions on the topics of climate change, environmental racism, and promotion discrimination. AECJ has mobilized thousands of Amazon workers to push for climate action through a public letter and a walkout. They have also worked closely with the Center for Community Action and Environmental Justice in Southern California to elevate stories about how Amazon impacts communities. Employees in impacted communities cannot do this work alone. Some of the most visible tech workers in these movements were fired after helping organize the live stream mentioned previously. Current workers should be here telling their stories, but the risk is too high. Amazon is not successful in a vacuum. It relies on public roads and infrastructure. It pollutes public air in vulnerable communities. It emits exorbitant levels of CO2 toward a climate catastrophe that will most severely impact communities of color in the United States and around the world. Amazon can no longer treat its workers and the communities it inhabits as fungible, disposable resources. Thank you.
Let's turn now to Anthony Hesketh. Anthony is a professor at Lancaster University. He's written widely on the issue of human capital management, and his work focuses on the question of what companies disclose and then what can be seen in terms of corporate performance. So Anthony, thank you very much for joining us. We're looking forward to hearing the results of your most recent research on the issue of investment strategy and human capital management. Thank you.
Hi, good morning, everybody. I hope you can hear me clearly. I'm just checking that you can hear me, Anne.
Yes, Anthony.
Great. Okay, thank you. Good morning, everybody, and it's nice to nearly almost meet you. I shall be focusing today really on three things. So if I could have the next slide, please. Thank you. My research really, over the last probably 20 years or so, I've become increasingly more interested in the way that we value value. And in fact, the way that we value value is changing. And many of the ways in which we use to formally capture that value and value creation are now out of date. And that's creating all kinds of different issues for us. What I call new modalities, value, is pathways through to how we might start to calculate and understand and manage the things that people value about our organizations and the future of capitalism. That leads me front and center into the issue that Anne has set me up with, and my reputation, I suppose, for working human capital. People are clearly material. I've never for a second doubted that, and I don't know a CEO on the face of the planet that would never describe his people as material. And yet they are largely invisible in the formal accounting and the financial fundamentals that are reported by organizations globally. And I'll come on to some of the detail about that in a moment. And then thirdly, I'm going to focus on this notion of what I call quantum clarity. So to almost give the game away right from the start, those organizations, I think, who can understand themselves and quantify themselves in a way through that understanding so they can report to the markets about the things that are important to them, and therefore disclose and report the direction of travel in terms of those things that are important to them, are, it seems to me in my research, which I'm going to put the case forward to you now in the next 5 minutes or so, actually those organizations that pull off quantum clarity end up outperforming those that do not. And I think this is a very interesting finding. May I have the next slide, please? Thank you. So valuing value, the next slide, please. I've come probably to the board meeting today via a circuitous route, but probably one of the main nodal points along that journey was EPIC, the Embankment Project for Inclusive Capitalism. And just as a reminder, some of you may have seen some of this research. CalPERS were a participant, Anne and colleagues. That just gives you a summary. It was harnessing basically the collective power and the value of some significant global players, around $30 trillion US under management. Just to give you an idea of the scale, US GDP currently stands at around, I think it's 21 trillion. So we're talking about a sizable amount of the global community. The next slide, please. You were in very good company. Again, I'm not going to rehearse all of this. And if I could just have the next slide, please. This was the problem that we were trying to contend with. It's certainly acknowledged, but I don't think it's necessarily understood, that probably over the last half a century or so, what we've seen in accounting is a dramatic shift. I mean, it really has been quite dramatic, whereby instead of the balance on a balance sheet where the asset value, 80% of that total value would be tangible and 20% intangible, we now have the inverse. So 80% of the total value of the business is intangible and 20% can be captured by accounting, what Rutlev at New York beautifully calls accounting fade in his wonderful book, which I would commend to you, The End of Accounting, if you want a nice contestable title to get stuck into during lockdown. Can I have the next slide, please? Haven't got time to go into embankment other than to say that we dealt with an enormous amount of complex issues, which human capital, it turned out to be, probably partly because of the evangelism of yours truly, but we recognize that as being a real material consideration. And it's one of the few places where there was largely uncontested agreement across all of those different participants that you've seen that human capital really mattered. So if I could have the next slide, please. Again, and the next slide again, please. I don't want to dwell on the methodology. I list it here just to simply say that it was a combination of both financial fundamental analysis, which is relatively technical, and then we used a new methodology to get really stuck into the way in which organizations report their human capital. And I've developed a new way of trying to understand and unpack that fidelity of value. Happy to take questions on that, either today or at any other time. But if I could have the next slide, please. One of the things that we did do is that we looked right the way across the S&P 500, the FTSE 100, the Eurofirst 300 as well, and the Fortune top 100 businesses. And what we were interested in doing was looking to see actually how deep and how wide human capital disclosure was by organizations. Interestingly, in the US, what we can see in the S&P 500 is that only around 75 firms report their human capital costs in detail. And of those firms, the vast majority of them, when we start looking at the performance of those organizations, just as a very quick broad brush test, we found that the majority of those, nearly 2/3, could be found in the top quintile of the S&P 500 performance measured via EBIT. And interestingly, and probably sort of more interestingly in lots of ways, those organizations did not appear or were very, very underrepresented in the bottom quintile of the performers of the S&P 500. And this is a pattern that keeps repeating itself. So I'm not claiming for a second that actually disclosing human capital means that everybody will be driving their performance, but it certainly piqued my interest and started me thinking we need to do a little bit more analysis. The next slide, please. So just to give you a breakdown of this, we, or probably I, have probably spent a very long time deciding what the human capital variables that we need to collect. And it's a technical discussion that we might have later on this morning, but we decided or landed on these 5 variables. And these are 5 of the variables that are actually part of the draft bill that's at Congress at the moment in terms of requiring US forms to report on these specific items. So workforce composition, so that could be anything from the gender balance, participation in management levels, ethnicity, all sorts of different things, right the way through spend on learning and development, turnover, people coming and going inside an organization, employee engagement, and then employee costs. And right there on the far right-hand side, we can see that the US actually, in terms of comparison across, certainly in comparison with Europe and the UK, where reporting employee costs is compulsory, the US is largely opaque as far as this is concerned. And I think this is something that's starting to grate now with the way in which society and its sentiment feels about the relationship between organizations and people. We can pull out a balance sheet and we can look at what the spend might be on a piece of plant, and we can probably depreciate that over 10 years and do a rather sophisticated analysis to find out whether we thought that was a very good return on investment or not. But if I'm an employee wanting to join an organization and make what might be a significant investment of my life in quantum terms by the number of years I'm going to be working, I can't even find out what they pay their people. And that to me seems to be wholly unsatisfactory and seems to be the way that we're going. If I may have the next slide, please. Thank you. And what we can see here, this is the UK, where actually, because of the European translation of IFRS, that's International Financial Reporting Standards, it's compulsory for European firms and UK firms over a certain size to report their employee costs in detail. And that's broken down across a number of different criteria. And there's actually been a lot of changes in legislation, which we won't go into now, in the UK and across Europe, around ethnicity, around gender, and a whole host of other factors, which have, of course, recently been coming to the fore in the US and elsewhere. And what we can see is that, obviously, in the UK, 100% of firms report their costs. And then the pattern, as we make our way across that chart, is relatively mixed. Could I have the next slide, please? So Anne mentioned the fiduciary responsibility of our organizations, and I started by saying I don't know a CEO would describe their people as immaterial. And in formal terms, what I think is interesting is that this chart shows that actually when we take the formal definition of materiality, which all firms in European IFRS have to report on in their audit, we can see that in this case, over 50% of UK firms spend a level on their people that is a factor of 20 the times of their formal materiality. So the fiduciary responsibility of reporting on our human capital is there before you in quantum terms. Next slide, please. This is just a summary, really, of the findings that we had. And there's sort of the big 5 variables there around composition, cost, turnover, training and engagement are the ones that I certainly would commend CalPERS and others, as I have the SEC, to demand from organizations to report of those organizations over a certain size. There are other variables and other details involved, which again, you can find out about through reading my work and seeing my submission to the SEC. I think critically, and one of the sort of really positive outcomes for me from working with EPIC and with people at CalPERS too, was that you challenged me to really sort of get my head around the idea of actually subjecting my research findings to the asset management standard. So that was actually getting into mean excess returns and risk-adjusted returns, and what we saw in 4 out of the last 6 years and 5 out of the last 6 years, respectively, those firms that report their human capital costs in the US, that's voluntarily, not out of any obligation, outperform using those indicators. So even by the asset management's own industry standard, human capital disclosures seem to be outperforming those firms that do not, which I think raises some interesting issues. And research, my research has been adopted by the World Economic Forum, from which you're going to hear a little bit later on this morning. The SASB, I'm hoping post my meeting with them on Wednesday, will be adopting the standard that I've helped them to devise using the indicators that you can see on the slide there. And of course, soon we hope, due to the work of people like Anne and others, we're trying to convince the SEC to join us in making human capital reporting mandatory, not voluntary. If I could have the next slide, please. Thank you. So I've flown through the research very quickly, and apologies for that. But I wanted to pull out some what I think are the key findings, where I think the data really start to jump out and make the case for this push towards quantum clarity in terms of greater disclosure, more transparency from our organizations and what it is that they do with their human capital. So if I could have the next slide, please. Very quickly, just to organize this chart in your minds, we broke the organizations down into 4 separate quartiles in terms of the depth of their reporting in human capital terms. So here in the UK, across the FTSE 100, what this slide clearly shows is the linear relationship between those firms on the left-hand side there who report the least could secure returns of, for every, in this case, pound sterling invested in their people, they would secure a £1.17 return in EBITDA. And then that goes all the way through to those who are at the top of the scale with this greater and deeper level of human capital reporting could secure returns almost 3 times that, at £3.01 for every pound that they invested in their people. If I could have the next slide, please. Of course, reporting in the US is less mature. It's certainly not mandatory to report on costs. But what we could see that even those firms on the far right-hand side there that did report more in terms of human capital still had a factor 11% greater than those at the far left-hand side there at the bottom. So that certainly, again, started to pique our interest. If I could have the next slide, please. Now, this is one of my favorite charts in the research, and we need to move from the left-hand side through to the right-hand side. On the left-hand side, we've got the operating performance of business. So we have EBIT and EBITDA there, as well as net profit margin. And what we can see is that those firms that report their human capital costs in the US, the darker bars, will outperform operationally those firms that do not. And in the middle of their retention ratio, you can see that those firms that report their human capital costs retain a significantly higher amount of capital, and as opposed to those that actually, the payout ratio for those firms that aren't disclosing their human capital costs. And then those factors on the right-hand side weren't statistically significantly different in terms of return on equity, return on capital employed, unlike the operational chart on the other side. Now, I need to qualify some of the data here insofar as it might be that those firms that aren't reporting their human capital might be in different funding cycles. And listening to Ben in his introduction about needing to take a long period of time in terms of waiting for the changes and the investments that you want to make to play out, again, one needs to look at this research with that intention in mind. But nevertheless, what was interesting is that when we dug a little bit deeper and trying to explain why the return on capital employed and return on equity might be a little bit higher, and for those firms that don't disclose, we found that they were much more likely to be leveraging higher levels of debt. So again, you may or may not want to come back and have a discussion with me about that at some other time. If I could have the next slide, please. This is also another favorite slide of mine from the research, because we often hear from the financial communities, particularly from the organizations themselves, the reporting entities, that the last thing that they want is to be compelled to actually report more human capital data. People don't want their annual reports, their 10Ks, their 8Ks or whatever, to become longer and longer, and they certainly don't want to attract any further costs involved in reporting that data. But nevertheless, what we found, again, is that those organizations, when we started to code their narrative reporting of human capital, on the left-hand side, those firms in the bottom quartile of human capital reporting would actually write an awful lot more, in this case, 27 narrative forms of account about what was going on in human capital inside their organizations, compared to just 9 on the far right-hand side by those with the highest levels of quantum human capital reporting. So the firms on the right-hand side were not only outperforming them by a factor of 3, you might recall, but they were letting the numbers do the talking rather than their narratives. So rather marvelously, what we can say to the regulator is that actually this level of reporting, where it's become mandatory, might even reduce the amount of words in an annual report and get us to focus on those data that actually matter and are pertinent to the material performance of the business. And that's kind of what we're all in the business of trying to understand in many ways. If I could have the next slide, please. This is just some modeling to explain actually what the costs of additional human capital might be relative to what I think might be the enhanced performance brought about by a deeper level of understanding around our human capital. So the group of people who participated in EPIC that I shared earlier in the presentation reached the same kind of conclusion pretty quickly, that I think even after a couple of years worth of more consideration, a lot more writing and even more analysis, I too have sort of really firmed up on now that those organizations that understand themselves, they understand what it is they're trying to do strategically, what the role of people is in what they're doing, how are they performing and how do they know, those firms that can report in a quantum way, whatever those human capital indicators might necessarily be, and feel confident enough to report that to the open market, seem to be able to outperform those that do not. And talking to audit partners in Big Four organizations, of course, whom we all know, to get to this data, they weren't challenging me on these numbers. In fact, they think they're probably overestimating the costs, which look relatively minuscule in relation to the rest of the costs of audit. But of course, we know that audit is a rather pertinent issue at the moment, or it certainly is in my neck of the woods. So if I could have the next slide, please. So that's just a summary of the findings. You can see the UK and the US in reporting in comparison there. You can see that those firms that report their human capital in the US seem to be located in the upper echelons of the performance realm in the S&P 500, which is interesting. That's repeated even more at higher levels of granularity in terms of human capital that we can see in the UK, Europe, and the rest of the world analysis. So I really do think that we've reached a point now where the materiality of people is absolutely critical. And there seem to be two things that are served by this. Firstly, the people themselves, the employees, have a greater level of transparency and insight into organizations, which is obviously commendable. But secondly, from a financial community and wider stakeholder point of view, the performance of those businesses is only going to be enhanced by a greater level of their understanding between bringing a human together and the financial investment that takes place, hence the term human capital. Thank you.
Okay, thank you. And before we move to the next presenter, we have a board member has a question on this section. Mr. Perez, please.
Thank you. Mr. Hackett, did I say that right?
Just Ant is fine, Anthony.
Anthony. Sir, on slide 10, and it looks like it ties into slide 18 as well.
Okay.
You touched on 10 briefly, and you said it's more interesting than anything, right? Is that what you said? There's no
slide 18. Slide 18 was my interesting slide, but they're all interesting. But
no. You I think you said on slide 10 that it's just saying that there's more work that needs to be done in this area. Because I don't.
Oh, sure. Yeah, absolutely right.
I don't understand the correlation between someone that discloses and making more, or a company that doesn't disclose making less.
You don't understand that, you're saying?
I do not understand that.
Yeah, sure. I mean, I think I was trying to say that I don't think that's necessarily causal. I'm just simply saying that were actually we to find ourselves in a situation where that chart was inverted, so actually the majority of disclosures were in the bottom performing quintile, I wouldn't be here and we wouldn't be having that conversation. It's simply that actually the fact that it is the way that it is piqued my interest. So in for formal statistical terms, what we cannot do is that we cannot reject the null hypothesis that human capital does not have an impact.
Oh, for
so
sure.
In formal terms, that actually then progresses me to then start doing that deeper level of analysis that I've undertaken. And the deeper I went in terms of the rest of the charts that we see, you can see that the case statistically from the fundamentals as well actually starts to stack up.
Okay, thank you. And then on slide 18,
yeah,
I'm not quite. So I'm not a investor by trade. And looking at the left-hand side of that slide,
yeah,
it would, for a layman like me, it would tend to show me that the return on investment on the other stuff was higher, but it's not because of the left-hand side. Is that what you're saying?
Yeah. I mean, again, welcome to the party. I mean, you're almost sitting around the desk when I was there with my team of coders. We're having that very same question and scratching our heads. How can that be? And so when one starts to dig a little bit deeper, and I alluded to it in the presentation, those firms that actually don't disclose their human capital costs are more likely to pay out more to shareholders, which is great news for shareholders and great news for asset owners such as yourselves. And as I was saying, it might be that they're on a different cycle of investment over a period of time. But what we can see is that when we started doing that analysis, we could see that those firms that were paying out a higher dividend and not disclosing their human capital costs had higher levels of debt inside the organization. So they were levering the organization at deeper levels. So rather than retaining capital, they were borrowing more money to do other things inside the organization. Now that, of course, plays out over different cycles. The businesses might be investing in their futures and what they're actually engaged in different kinds of ways. So I can't possibly judge on that because I don't know what's going on. But the data are very revealing in that those firms that are not reporting their human capital costs and have higher levels of payout ratios are leveraging more debt. So I wouldn't want to suggest for a second that they might just be borrowing more money to throw that at their shareholders, but I would certainly put that onto the agenda for a conversation. And those organizations that can't actually articulate a very clear story right now, I mean, it's very clear that financial analysts have pretty much written off dividends for this year. They're now having a conversation around what does 2021 look like. And those organizations that can't articulate what they're investing in relation to their operations, and what we'd really like to see now is a much more detailed conversation around what they're investing in terms of their people, which will drive also the value of the business. If they can't give us a satisfactory narrative in that space, then why would I want to invest in them? I would caution myself and others to move away from those organizations that do not have a convincing story in what is something that is clearly material to the performance of the business.
Thank you, sir. It's clear I have a lot more to learn in this area. Thank you very much.
Okay, Ms. Brown?
Thank you, Henry. I want to go back to slide 10. I think I heard our presenters say, I was asking about the cause and effect relationship.
Yeah.
And I think I heard you say you can't actually say which it is. Is that correct?
Gosh, that's a hugely deep philosophical question, but no, I can't. But what I can do, which I think is what I alluded to, is that logic would suggest that we are onto something. And of course, if every single firm in the S&P 500 were to report its human capital spend and disclose all of it, would all boats rise on that tide? Is an interesting question. And I think what I was trying to allude to and where we landed with Epic was that actually, if those firms that understand themselves, that have got their stuff together and they know what it is that they're trying to do, it's what I call the 4+5. What's the business trying to achieve? What's the role of people? How are they doing and how do they know? Fine, that's the strategic question that you as fiduciaries are actually responsible for challenging your team about. But you also need to be asking them 5 other questions, which is, how are our people performing? What's the direction of travel? How do they compare to your competitors and others? Actually, where am I going to invest and why? And if they can't answer those kinds of questions, then I'd be wanting a different team in front of me running, the operations of that business.
Right. Thank you.
Ms. Taylor?
Yes, thank you, Mr. President. Anthony, thank you for your presentation. I had a lot of questions that Mr. Perez already asked, but the correlation isn't something that you guys have figured out why the performance is better. I'm wondering, are you thinking about, and I know if they're not reporting, this could be hard to do, is it better performance and better payout, or better performance versus better payout for the companies that aren't reporting paid higher dividends? Is there a correlation between what they're paying their workers? So when I assume that if you're having to report or choosing to report your human capital management, that perhaps you're paying better. So, and if you're not reporting, that's hard to correlate the two to find that out. And that could be also why the the dividends payout is higher, along with the higher debt that you're talking about. That you can see. Is there a way you can get a picture of that with these non-reporting companies?
if I understand the problem that you're trying to put before me is that what we've tried to do is we've gone inside and looked at all of the investor relations publications, and we've actually got a few sneaky other ways of trying to find out people data from those that don't actually disclose their data, and the picture's quite mixed. So to be fair, there are organisations that do not report their human capital costs that are flying. Let us be absolutely clear, yeah. But also the picture is much more mixed in terms of those firms that aren't reporting their human capital aren't flying a lot more relative to those that are. And I do genuinely think that we are onto something, and we won't know the answer to this because it's pure speculation until we can see actually the performance of those firms and what their human capital costs are. Because the figure I was using is an equation that I've constructed nearly a decade ago now, called return on investment to talent. So it's a way of extracting from fundamental analysis that enables us to look at the relationship between the investment in people and actually the performance of the business using fundamental factors. One of my big bugbears is people don't use very clear data. And I know that the regulators get very uneasy, and particularly people who are very critical about the kind of ideas around human capital reporting, is that they don't want to see funny numbers, what they call water in the balance sheet. And they want to be very clear about that. But so without actually a pure line of sight through to what that fundamental spend is, so I can factor it into the equation, I can't answer the question that you're giving me. But what I did do is that I used the proxy forms, which US legislation required firms actually to then disclose what the median employee's pay was. And when I did that analysis, I could see that those firms that were reporting their human capital costs outperformed those that were not. Discuss.
Thank you.
Ms. Oliveris.
Thank you, Mr. President. Anthony, how would you apply your findings to CalPERS and its operations? So asset owners also have significant human capital costs, and there are performance issues as well. And in terms of benchmarking our investment performance against other asset owners. So how would you look at our human capital costs and reporting to improve our investment performance?
Well, I take a more granular view. So I haven't looked at asset owners such as yourselves with that level of analysis, but what I have done is I've looked at, say, investment banks, because one of the wonderful things about the banking industry and the finance industry is that they have bonus pools. And in fact, they're very clear about actually reporting on the costs of their people, because that signals to the market a whole ton of other things that people are very interested in doing. And so one can actually break it down by different levels of analysis. And you can look at for instance, the correlation with engagement scores. Now, engagement, employee sentiment is actually a rather interesting number, because a lot of the analysis I've done doesn't find a straight line correlation, causal driver between the financial performance of a business unit and how people feel about working inside that organization. But nevertheless, again, the logic tells me that if I could really understand the sentiment and the culture of an organization, and I knew that part of the organization was well run and people felt happy inside there, I can show that performance will actually go north. And the amount of CFOs I've spoken to over the years that actually look forward to seeing the engagement results, because they know they'll see at business unit level actually that where they see a clear shift in the data north, they will also enjoy a productivity increase inside that firm. But what you don't get, and what I would want to see from firms such as yourselves, and also probably what I would love firms such as yourselves to require of those assets whom you're investing in, is actually much higher levels of granularity around employee engagement. So if I was to say, what's the employee engagement score for CalPERS, you would probably know the answer to that, but you probably wouldn't know about its variegation across the rest of the business. And that's what I'd be wanting to explore. And I'd be able to see that different level of performance inside there. So I could really see how different parts of the business were performing. And of course, as an investor, as an analyst, I'd be very interested in looking at those aspects of the business where I know the engine of the performance is in terms of some of the bottom line areas, So I'd be very interested in how human capital is performing in those. So to take any of the big, the indicators that we use, just say turnover as one of them, if I can see they're leaking people or they have a relatively high level of turnover, that will be a conversation that I'd be wanting to have with the team of whichever organization that might necessarily be. Now, churn's not always necessarily a bad thing. In some organizations, they want to see churn. But in somewhere like, say, in wealth management and investment banking, for instance, that's somewhere where you don't want to see a lot of turnover because it destroys the relationships with your clients. So that's only going to hurt the business. So you really will be able to get insight into that.
Thank you.
Mr. Ruffino?
Thank you, Mr. President. My question is for the first panelist. I can ask it now, or I can wait until all the panelists make their presentation.
Okay, why don't you wait then, because we have a couple people that have questions on the entire package. So we'll come back to you then, Mr. Ruffino. Is that okay?
Absolutely. Thank you, Mr. President.
Okay. Okay. Okay, that Ms. Simpson.
Thank you.
And Ms. Simpson, by the way, I understand we do have a request from the public to speak, and we will also allow for the public comments at the conclusion of all of the speakers. So you can call in and get in the queue and be in the waiting room so that when the board finishes its questions, then we will call on the public for their comments. Okay, Ms. Simpson.
Thank you very much, Mr. Jones, and thank you for the questions. All the work that CalPERS has done in this arena is based on research. We know this is a very difficult issue because the disclosure isn't there, so we don't have the data. So one of the priorities in our Sustainable Investment Strategic Plan is focusing on the need to improve data and improve corporate reporting, because this is going to help us much better understand. In the meantime, the work that we do with engagement is extremely important. This is where CalPERS, as a part owner of companies, has confidential, private conversations with companies who we regard as our partners. Why? Because we rely on the investment returns from our portfolio to pay pensions for our members. So as fiduciaries, when we're engaging companies, we want to ensure that we understand the dynamics at work, but also that we can bring our long-term perspective as fiduciaries to bear on big questions around value creation and also on risk mitigation. And our work on human capital management has been carried out through the Human Capital Management Coalition. And I'm delighted to say that Cambria Allen Ratzlaff, who's the chair of that $4 trillion partnership between investors, has been leading the work. And she's coming today to share the experience of this coalition and also the value of us taking a partnership approach and working in this quiet, behind-the-scenes ways with companies. And where needed, we bring issues to the AGM with the proxy vote. But Cambria, thank you for joining us, and over to you.
Thank you so much, Anne. Can everybody hear me okay? Excellent, thank you. So I'd also like to extend a huge thank you to President Jones, Vice President Taylor, state and local officials, representatives of CalPERS beneficiaries, and the CalPERS staff for inviting me to share our work with you today. I have three main goals of this presentation. First, I'd just like to provide you with a background on the Human Capital Management Coalition, who we are and what we do. Second, discuss why investors care about human capital. I think we've heard quite a bit from Anne and Ant and Hannah, but I'd also like to just reinforce how we view human capital and its role in the firm, and creating and sustaining value over time. And then third, discussing our recent focus on improving human capital disclosure, beginning with our 2017 rulemaking petition to the Securities and Exchange Commission and our two-pronged hybrid reporting approach, which will require disclosure of 4 key universal metrics along with principles defined information that can be tailored to companies based on industry and individual companies, and why we think that that's the best approach. Next slide, please. Okay, this slide just provides a little bit of snippet about the Human Capital Management Coalition. I co-chair the Human Capital Management Coalition along with Mary Morris, who's an investment officer at CalSTRS, and I understand previously with CalPERS. We were co-founded in 2013 by 9 large US-based and global funds, including CalPERS. And we've now grown to 29 global asset owners and some asset managers, and as Ann mentioned, representing over $4 trillion in assets. We came together to further elevate human capital management as a critical component in company performance. We, as investors, we realized that our voice was missing from the conversation around the importance of human capital and human capital management. It was something that we really needed to include in our own analysis, investing decisions, engagement decisions, and voting decisions. So we engaged companies and other market participants to try to understand and improve how human capital management contributes to the creation of long-term shareholder value. And before we move on, I'd like to just share a little bit of interesting trivia on CalPERS' role here. As I mentioned, they were a founding fund, but actually the genesis of the Human Capital Management Coalition began at the Council of Institutional Investors Spring 2013 conference, where Ann Simpson raised her hand and asked the investors in the room how we as long-term investors could engage on human capital management issues at the upcoming Walmart shareholder meeting at the time. And I'd also like to really highlight the early contributions from CalPERS, especially Bill McGrew, who was really instrumental in getting us off the ground, and James Andrus and Tamara Sells with their invaluable assistance on our 2017 shareholder petition. This also brings me to an important part about who we are, especially in light of increased interest in and activity around human capital. We're a group that was started by investors to really assert the investor voice around the importance of human capital. We're not a formal organization. We don't accept money. We don't have a budget. And we have really our only interest is our stated mission, especially the last piece, to encourage the adoption of long-term value-creating HCM practices and performance. And we realize that as large investors working together in a coalition, we really can most effectively advocate for critical market improvements that could lead to better investment outcomes for our funds. Next slide, please. Thank you. Here we have a high-level timeline of our work since our founding with links to important documents. Please feel free to click on them if you want to dive a little deeper into this. But I'd like to highlight just a few events. I'll talk about the rulemaking petition a little bit later from July 2017. But I'd also like to again thank CalPERS, Ann Simpson, along with Ann Sheehan and Damon Silvers from AFL-CIO for their work with the Investor Advisory Committee at the SEC to really advocate for this issue. And in addition to the recent rulemaking from last year on human capital disclosure, their most recent work on improving disclosure in the age of COVID, including on key human capital issues such as workforce composition and health and safety. Next slide, please. Okay, so Ann mentioned this in her opening remarks, but before we get too far into this discussion, I'd like to level set on how we define human capital, because there are a number of definitions. And the way that we define it is the knowledge, motivation, skills, and experience of a company's workforce, as well as its alignment with the company's mission and values. So basically, we're going beyond employees to include the whole of the talents of the workforce. And as we see in the slide, we view human capital as a fundamental asset. And we use this framing to underscore the importance of investing in human capital. As Ant mentioned, CEOs of our largest publicly traded companies acknowledge this on a regular basis, that people are their most important asset. And we should be investing in that asset versus treating human capital as a cost, which we currently do in corporate reporting. Next slide, please. Okay, so we wholeheartedly agree that human capital is an asset. This slide lists some of the corporate practices that are included under the banner of human capital management. And there's broad consensus that human capital management is important to the bottom line. And Ant went through quite a bit of that research, and I'll share a little bit more with you. But let me underscore the point that skillful management of human capital really is associated with better corporate performance, including better risk mitigation. Decisions around investing, especially for those those of us who have a fiduciary duty to our beneficiaries, should be dispassionate. Um, and we're interested in this issue not because it's a social pursuit or an effort to push our personal views about the value of talent to the firm, but we focus on this, on human capital, these collective talents of the workforce, because we view them as absolutely fundamental in allowing companies to compete in an environment where ingenuity and the ability to quickly adapt to novel technologies are the keys to lasting success. Company reporting to investors should reflect this reality, recognizing that effective human capital management is critical to building and protecting company value over the long term. And that's why it's not just us. The largest asset managers, including BlackRock and State Street, have made assessing the quality of human capital management a priority in their investment and engagement activities. Could we go to the next slide, please? Thank you. So when we talk about human capital management, we're really talking about a company's ability to generate value in return for investors. And the connection between human capital management and corporate value creation has only continued to grow considerably over the past several decades as we've transitioned toward a knowledge-based economy, making human capital the engine of economic growth. We're talking about a shift from things to services. I think Ant mentioned this in his remarks, but it's worth repeating. Intangibles in 1975 made up less than 20% of the value of the S&P 500. It now makes up over 80%, and that's in 2015. So I'm sure in the past 5 years that's grown as well. And we really consider how well companies manage their people as fundamental to navigating these shifts, ensuring the ongoing creation of value. Ant gave you a lot of information about the research supporting the conclusion that companies with effective human capital management perform better than those that manage their human capital poorly. Across a number of dimensions, but I'll repeat them. Investments in human capital are associated with higher total shareholder return, return on assets, return on capital, profitability, and overall firm performance. Additionally, investments in training and development, health and safety, employee engagement, diversity and inclusion, and workforce composition and staffing are associated with increased workforce productivity, reduced turnover, and higher customer satisfaction. And we cited a number of resources in our 2017 petition that can go into a little bit more detail on that. So as Ant mentioned and Anne has mentioned, the value of those talents aren't captured by existing reporting in the US. Here, companies are only required to disclose employee headcount, and that disclosure requirement was developed in the 1970s. And that really doesn't tell us much as investors. As an investor, it's easier for me to get information on the depreciation of a company's computers than the people using them to prevent a cyber attack. And while we've certainly seen some improvement from some US companies, really only a handful of companies in the US report anything that I think we would consider decision useful. And they don't report because they don't have to. With this information gap, we simply do not have reliable access to information we need to make fully informed decisions about how we direct our financial capital and exercise our rights as shareholders. And we really need to narrow that gap. I also mentioned current events, which further highlight the need for better information. COVID-19, recently the SEC has been releasing guidance to companies on reporting in the age of COVID-19, which consistently and prominently highlights the importance of human capital management as companies cope with the financial impact of the pandemic. The Human Capital Management Coalition also responded, sending letters to 31 companies, drawing on the SEC's guidance, specifically focusing on disclosure related to enterprise risk management, business and supply chain continuity, and pandemic planning, financial implications, including balance sheet resiliency, revenue liquidity, capital allocation, workforce composition and adjustments, including furloughs, layoffs, employee benefits and protections, and workplace health and safety. Also, inclusive companies are really better positioned to address some of the racial justice issues that we've seen highlighted most recently. And I'll talk a little bit more about that when I go into the data on why we picked the metrics. So what are we doing now? As I mentioned, in 2017, we filed a rulemaking petition with the SEC asking for much stronger human capital reporting from U.S. public companies. And we did this intending to kick off a dialogue on what we can do as investors, companies, and other market participants like analysts, consultants, et cetera, to improve reporting. And last year, the SEC responded in releasing a draft rule seeking to change existing human capital disclosure requirements. And our comment is also one of those linked on slide 3. But to give you the Cliff Notes version, we're urging the SEC to take what we call a hybrid approach to human capital disclosure. And with this approach, we have 2 buckets of metrics. The first bucket lists 4 specific metrics that are closely defined but universal in nature. They're applicable across all companies and are metrics that we view as foundational that investors need, and all companies should therefore report to help us form a baseline understanding of what human capital resources the company is working with. Those are number of people employed by the company, but broken out into full-time, part-time, and contingent work, total cost of the workforce, turnover, and workforce diversity, including diversity by seniority level. The second bucket is really more principles-based. It's equally important, but these are metrics that may change slightly based on the industry or even individual companies within an industry, depending on the business strategy, acknowledging that human capital metrics to measure and monitor progress might look different. So I'll go into each bucket in a little more detail, but I do want to preface, oh, and I'm sorry. And I can't.
Cambria, yeah, I was just going to say there's more detail on the 2 slides, but I'm very mindful of time. So would it be all right if we took a break there, and if the board has questions on these slides, we can come back to them?
Oh, sure, that's perfectly fine.
Yeah, because I think you've set the detail out beautifully. But thank you very much.
Sure. So
with that, thank you very much, Cambria, for giving us an insight into that work. Let's turn now to a perspective from the business community. We're very grateful for the National Association of Corporate Directors joining us for this session. The speaker here will be Ashley Marchand-Orme. She's the Senior Manager of Strategic Initiatives at the NACD and is doing work on board culture and dynamics, diversity and inclusion, the nation's shifting demographics, and racial justice. She also hosts NACD's Future Fluency podcast. Well, that's a talent that I would love. To be fluent in the present is quite a challenge at the moment. To be fluent on the future, even more impressive. So, Ashley, I hope you've been able to join us through the connection.
I have. I'm here.
It's lovely. Well, welcome, Ashley. We're looking forward to hearing your thoughts from the National Association of Corporate Directors. Thank you.
Thank you very much, Anne, for that wonderful introduction. And good morning, everyone. I want to start with a brief reminder of who we are at NACD. We are a nonprofit association of now more than 21,000 members who sit on their organization's boards. NACD has been setting the standard for responsible board leadership for more than 40 years now. And of course, given the current environment, responsible board leadership is as important as it's ever been. Instances of police brutality and the resulting calls for racial justice and an end to oppressive systems have put institutions under the microscope. Companies are being held accountable for very visibly for the ways that they or representatives from their organizations treat stakeholders. Now, last month, NACD's CEO, Peter Gleason, responded by publishing a statement expressing solidarity with the Black community and acknowledging the injustice. I'll just very briefly read an excerpt from that statement by Peter. He starts by saying, "Our fellow Americans in the Black community have endured racism and intolerance for too long. That we are experiencing this pain in the midst of the most serious public health and economic crisis of our lifetimes only compounds the toll. NACD members have a responsibility to be stewards of diversity, openness, and tolerance in their organizations, and to provide wisdom and leadership to businesses as they inevitably experience both highs and lows. Now is a new low, a time of true crisis, and we know that our members are facing the hardest days of their directorships. We take our role in supporting their work very seriously. That statement goes on to say that today and every day we stand together with our Black community, employees, and members. Now, of course, most of the feedback that we've received about that statement has been positive, overwhelmingly positive. And we're hopeful that what we're experiencing right now is a bit of an awakening among corporate leaders. They realize that they have to get comfortable talking about issues of racial injustice, that they have to get comfortable taking meaningful action or face significant reputation risk if they don't. Part of what we need to realize here is that there's a strong focus, obviously, on the systemic nature of racial injustices and anti-Black racism. But those systematic problems were created not just by our government, but also by the private sector. So the business community helped build systems that were highly discriminatory, and businesses had to comply with the discriminatory policies established through Jim Crow laws, for example, which were in place, of course, through 1968. So then the question becomes, what does all of this mean for boards? It really means addressing bias at your company with an understanding of the discrimination experienced by all of your stakeholders, whether that be with candidates for jobs that you have available, your employees, customers, suppliers, the communities impacted by your company's physical location even. It also means understanding that the board really sets the tone by embracing diversity and inclusion. We all know that diversity is lacking at the board level in the US, and board turnover is low. Boards aren't really adding seats to the board to make room for diverse candidates right now. So at NACD, we've been trying to push forward thought leadership around increasing diversity and inclusion, but specifically also addressing some of these racial injustices. There are a couple of resources and things I just want to bring to your attention. First of all, we hosted a virtual town hall meeting. This is earlier in June. We had about 670 attendees tuning in to hear from a panel of a few Black directors, folks who are in our own leadership community involved in our NACD chapters, and we also had a diversity and inclusion consultant. Now, during this town hall meeting, the directors described how in boardrooms, the tone of conversations around diversity has changed, that it's gaining more attention and attentiveness by directors, that there's likely to be a lasting impact to the movement that we're seeing. One director shared that the momentum around the Black Lives Matter movement specifically has made clear the importance of what she calls the 4 Ps that directors need to be paying attention to: people at their companies, the talent pipeline, so how those people move from an entry-level position up in their organization. 3rd P being procurement, so thinking through your suppliers. And then the last P that she mentioned was philanthropy, which is really thinking through how you give back to the community to address some of the racial injustices and discrimination that have been institutionalized. We also now have a recording of this event available, so Anne, I'll make sure I provide that to you as well. I also want to bring attention briefly to an article that we published. We published this article in June called "How Boards Can Help Address Systemic Racism in America." Now, in this article, we describe the needs for boards in collaboration with management to demonstrate renewed commitment to purpose and values, that your culture as an organization should be part of the solution, not part of a problem. We also talk through the importance of engaging at the board level with your diversity and inclusion leader at your organization. And I'll speed through the rest of this in honor of our time, but the blog also discussed the importance of holding your CEO accountable. So making sure that you put performance objectives in place that tie back to the D&I goals that you have as an organization. The final tool is something that is soon to be published, so I'll be very brief here, but it essentially is a discussion guide that provides key questions that boards should be asking to advance racial equity in their own business practices. So this tool provides a list of questions that address issues related to human capital management, even advertising and marketing, your sales practices, how you engage with third-party vendors, and even how you consider your political and charitable contributions. So once that is live, I'll also provide that to Anne. But in closing, as a quick reminder of Peter's statement that I mentioned earlier, the statement ends with this note that I want to leave you with, that NECD's purpose is to elevate board performance, helping our members to create positive impact through their work in the boardroom. So if there's anything else that we can do to help you, the CalPERS board, address the issues of racial injustice and equity, please let us know, and I'll end there so we have time for questions.
Okay, thank you. We do have a number of questions. The first one is Mr. Rufino.
Thank you, Mr. President. So I do have a question for Ms. Tia, but before that, I want to take the opportunity on behalf of the State Treasurer, Fiona Ma, to thank all the presenters and for taking the time out of your busy schedule today. The presentations have been very interesting and valuable for all of us. But back to Ms. Tia, if I could, question is, what would need to be different at Amazon so that workers could feel safe to talk with investors about the risks that they see at their company?
Sure. Really, they need to feel safe to not be fired for speaking. But what we've seen over the last 6 months particularly is a lot of retaliatory behavior from Amazon. They claim that these activists are not being fired for their activism, that they're instead being fired for breaking various internal policies. But those internal policies seem to be unequally used for firing. So, for example, I think a couple were fired for the solicitation policy over Amazon email, which is basically saying that you can't ask fellow employees for anything over email. And that's something that, of course, is very regularly broken. So for them to be fired for that, it's just being unfairly applied or unequally applied. So I think Amazon needs to just be more open to employees voicing their concerns. And I really think Amazon should be listening to their employees, so it shouldn't just be that Amazon employees go and speak to external parties. But I know around the Black Lives Matter movement of the last month or two, Amazon has done a couple of, they've made a couple of moves around like donations. So they've, I think, donated their own funds to certain organizations, and they matched employees' donations to a few organizations for some amount of time. But Black employees within Amazon say that not enough is being done for them as employees. So it seems more like Amazon is trying to do the right thing from a PR perspective, but Black employees internally do not feel supported or heard. Yeah, hopefully that answers your question.
Yes, it does. And actually, it goes without saying, having a safe process in place would not only benefit workers, but it would benefit investors as well, because we would have more accurate data to do our work of assessing where and how to invest. So absolutely. And quickly, Mr. President, also I want to, the presentations today they've shown that the realities of the economy make clear that for CalPERS to protect its portfolio and accurately assess risk and seize opportunities, the fund and others in the investment world need to aggressively tackle two issues, which have been sort of already brought up. First is, what can CalPERS and other investors do to keep workers safe in general? And of course, during this pandemic, it is not only clear that it's vital to worker safety, it is also vital to the economy and thus to our returns. And the second issue is that, as it was brought up already, many major companies have spoken out since the death of George Floyd and declared that they want to work to stop racism and that their business depends on it. So the question is, how can we work with them and others to address racism and reduce the risk it places to CalPERS portfolio?
Okay, thank you, Mr. Rufino.
Thank
and
you.
I'm sure, yeah, you're welcome. Thank you. And your comments are well taken. And I'm sure as we continue to have dialogue going down this path, Ms. Simpson and our team will be addressing those very issues as we move forward. So the next, Ms. Yee.
Thank you, Mr. President. First, I want to thank Ann Simpson for really putting together a really stellar panel, and I think the topic could not be more timely. And I wanted to just address a couple of my questions, maybe starting backwards. Really appreciated the presentation from NACD, but when I look at just the role of investors in all of this, and really why the Human Capital Management Coalition was formed. And the idea that our focus has to really remain on long-term value creation. I guess I'm not convinced yet that we've done enough with respect to elevating this issue with companies. The idea that the response so far, and I'm thrilled to see many companies really rallying around the Black Lives Matter movement, certainly the recent protests about how much change is needed, but the response really, in my mind, has been lacking with respect to their own investment in their employees. And so I guess my first question is just to the panelists, what observations have you made with respect to what companies are doing, and maybe along the lines of the most recent statement by the U.S. Business Roundtable about the need to really have companies focus on delivering value to all of its shareholders, including all of their stakeholders, excuse me, including their employees.
Maybe I'll jump in here if that's okay. So very interesting comments. And I feel like you're right. We're at the point where, yes, we are hopeful that we are seeing change. I think if you were to look at what some of these public statements have done, yes, some of them have maybe fallen short, that they haven't really been as focused in on the action. And that's what we're pushing organizations to think through. It's not just what you can say. This is not about brainwashing an issue, right? This is about saying, we understand that within the Black community that there have been limitations placed on them as far as how they can participate in the economy, right? And so the very real way to think about solutions is, okay, well, what does this mean for our employees? How are we helping them to participate in the economy? How are we valuing them, as part of our stakeholder group? I think, it'll be interesting to see how other companies start to step up. I think you all may have seen recently the announcement by Goldman Sachs that they are not going to help companies go public unless they have a specific, some board diversity. So I feel like unless companies take the initiative to actually use whatever the power that they have specifically, we're not really going to see, this will be more of a flash in the pan. And we're hoping that that's not what it is. We do want to focus on long-term value creation. And we know that the long-term solution to this is something that begins now, but it begins with action and begins with understanding. Again, going back to what we were discussing earlier, is understanding the real impact of what institutional discrimination has done. So yes, I feel like it's up to other organizations to also help us push forward that agenda, figuring out what it means for you, for CalPERS to move forward and promote greater equity among the companies that are maybe within your portfolio. So I feel like you're right. It's a complex issue. Hopefully we're going to see more motion forward, more meaningful action.
May I jump in? This is Cambria. Yeah, I'd like to 100% echo those remarks. And I think, as investors, we've focused a lot on board diversity and have pushed for diversity in gender, investors are starting to push for racial and ethnic diversity on the board. We need to do way more of that. But I think also, one of the reasons that we've been asking, or we think that companies really should be reporting workforce diversity data with a focus on gender and racial and ethnic diversity in the top levels of a company, is because, we really need leaders at companies that reflect a broader group than we're currently seeing. And I think certainly diversity in the C-suite, below the C-suite, among managers, really makes a huge difference at a company. I mean, you can say that we care about diversity, and we've seen a lot of these comments from companies, and we don't want to discourage companies from certainly acknowledging these issues, but they've been here for a while. This is kind of from this is fundamental founding of the U.S. stuff. So, there are investors currently that are calling on companies to report their EEO1 data, which includes diversity by employee band, including senior band, from major companies who have made these comments and these statements, to really see, okay, are you guys really doing something, or is this more lip service? So investors really are expecting way more.
Mm-hmm. So, and then just one other question, Mr. President. So, as we're seeing business models change, and particularly this whole phenomenon of the fishering of work. So, really, the traditional employee-employer relationship is now kind of a worker-contractor relationship. How do you see this really complicating the challenges of mandated disclosure? How does that even, kind of get incorporated into the work that we've all been trying so hard to just get, companies to disclose, when we know that this is going to be much about the future of work?
I'd love to take that one on, if I may. That's a great question. And I think what we're seeing now is something what I call the economy of experience. And by that, I simply mean that people want different relationships with organizations. What people want from organizations and what organizations give them have changed fundamentally in terms of the demand from employees, but organizations still use the same structures that we were using 100 years ago. And that's going to change. And I think, without the levels of transparency, without actually being able to see what it is that I might get paid, there's all these other kinds of data points. Huge amounts of data are now becoming available. People are starting to crunch this data, and it's creating a new kind of economy, a new way of evaluating businesses against other ones. So just one, relatively anecdotal piece of evidence here in the UK, we've actually had a firm absolutely drawn over the coals. They've seen huge institutional investors walking out of the door in the last 5 days, because it's been clear that they've not actually been looking after their workforce. They've been in working conditions that have not been COVID friendly. They've been exposed for this. And actually, it's not just who you are. People don't want to do business with people that don't do business in a correct kind of way. So these new kinds of relationships are starting to permeate out of just the relationship between organizations and individuals. They have real material implications for the way that these organizations, their infrastructures and their hinterlands, will be damaged as a clear result of this. So the question now is, if you're not disclosing this level of information, what have you got to hide? I mean, even if it's voluntary, why are you not telling us what you pay your people? I mean, you might as well tell us. I mean, it's not as though you're giving away. I mean, if we know that I've spent 8.7 billion euros paying the employees of Unilever in the last year, that is not competitive advantage given away to my competitors. There is no reason for this anymore. It's indefensible, and it's right the way across the board.
Yeah, and that data is all available, so it's not even, that's even a rationale anymore. I just want to end, Mr. President, by just thanking our staff, because I know recently SEIU President Mary Kay Henry had addressed a number of letters to our real estate investment managers to really impress upon them to be sure that workers in many of our commercial office buildings remain safe during this pandemic. And I know that the CalPERS staff has really been working with our managers on that issue. So I just wanted to call that out and just say thank you on this occasion. Thanks.
Okay, thank you. Mr. Rubalcaba? Mr. Rubalcaba?
Thank you, Mr. Jones. Thank you. First of all, I too want to join with my fellow trustees, and thank Ann and the other speakers. I think it's very intriguing to me. And I think one clear common element is that the need for data and information. That's what one of the principal elements that investors always look for to try to make the right decision. And so my question speaks to what and I think Anthony was getting to that. I mean, how do you, one is what data you need, but I think how do you, how are you going to standardize it? How do you study it? How do you write it in your report so you can do the analysis? I mean, I think there's, I'm intrigued that you're developing these methods and stuff. And but I guess my question is, what can CalPERS do to help promote the regulatory agencies to require this information, this data sharing that will be public? And that's one question. The second, I just, because I don't want to lose my point here, my step here, I do want to join with Ms. G and Mr. Rufino and all this. We are in a time where this pandemic has really drawn bare the need for the value of human capital and how it can impact the investment returns and people's livelihood, as a matter of fact, and health and safety. So I thank everybody. I think it's real timing. I thank everybody that was involved in making this panel, and I thank you for the courage of Hannah and everybody else is speaking. Thank you very much.
Okay, thank you, Mr. Rubalcaba. Ms. Milton? Your mic?
There we go. Thank you, Mr. President. And I want to echo the comments of my colleagues, thanking staff and all of the panelists for an incredibly important and very timely presentation in this troubling time in our country. My first question is for Ms. Alan Ratzlaff. And I applaud all of the work that's being done to increase diversity, but I did not hear any reference to sexual orientation or gender identity in the efforts or in any of the metrics.
Do you want me to talk to that one?
Yeah, actually.
Cambria, I mean, I don't mind either way. I think Cambria and I are probably totally on side in relation to this. I mean, organizations are reporting on that data. And, you know, if one was looking at a report card or it was parents' evening, we'd be saying, look, you know, actually corporates working hard, but could actually work a lot harder and be a much more focused and much more transparent in this area. And really just picking up on relating the two previous questions that we've had to join them together. The issue now is that we've pretty much bottomed the kind of data that we need to see from organizations. I don't think we need another debate. And it's very clear. Sexual orientation is actually a very easy data point to collect. It's very easy to actually make transparent. And it's very easy to lock into a lot of the indicators that we're using, for example, like progression through business. So we are now starting to see, for example, in relation to gender, we're seeing speed to management positions across gender, across ethnicity, and there's no reason now why sexual orientation cannot also be incorporated into that to get a higher level of transparency. And I think we're going to see that because it's clear there has been a step change in wider social sentiment. And organizations in their fiduciary responsibility absolutely have to recognize that they need to align with that. So I totally endorse, you know, Lisa's question. And I think, you know, again, CalPERS could play a fundamental role, as can HCMI and all the rest of us, to actually, you know, sort of push this forward. So there's no reason why. It's not, you know, should you do it? It's why are you not doing it now?
Yeah, I 100% agree with that. And I would be remiss if I didn't point out the efforts of two of our members, New York State and the New York City pension funds, in pushing companies to disclose data on gender identity and sexual orientation. Please.
Thank you. My next question is a little different. It was triggered by Ms. Thier's presentation, but I will open it up to everyone on the panel. Organizations such as Amazon and Walmart are notorious for their hostility to organized labor. And my question is, to what extent has the hostility to organized labor created an environment in which employees encounter greater fear and trepidation in making known any complaints regarding their working conditions?
Again, I'm happy to take that. I don't know whether Hannah might actually want to answer that question if it's directed to her.
Yeah, I can answer. I can speak on that a little bit. I think the recent firings over the last 6 months have definitely sent a chill throughout the company. People are definitely afraid to speak about their experiences or their concerns about the company, for sure. Some of us are trying to create ways to communicate outside of company communication platforms so that maybe we can speak more freely and safely. But people are definitely fearful. Yeah, I guess that touches on it.
I think just building on that, pre-COVID, there was an interesting development in the coffee shops across the Northeast Seaboard where, because coffee shops weren't disclosing payment information, actually barristers were actually comparing data. So they started building new data sets and they were sharing all kinds of different ways so they could have advocacy in that area to actually, sort of negotiate a higher salary with their employers. Well, this could work in just about any kind of data currency where you can create an economy where you can actually create the transparency that the firms might not necessarily want to give us. And of course, I think we're only going to, this is what I mean about this widening data footprint. I think organizations who want to have downward pressure on control in terms of transparency and insight into their firms are on really, shaky foundations for the future. And again, I think what we're talking about here could quite easily be built into the data metrics, because one can see the level of complaints that are brought against management, for instance, and how many have been upheld as a proportion of that. So one can actually see the direction of travel in relation to those. And again, as an analyst, the firm might want to, sort of protest its innocence. But if I'm seeing a clear material blip in the number of complaints coming in from employees, I'm only going to start to think that my capital is at much more risk than it would ordinarily be, so.
Yeah, and speaking about people reporting issues internally, I've heard a lot of stories from people where when they report to HR, they either feel unsupported or that action ends up hurting them and doesn't end up having any effect on the person that they're reporting. So, for example, people will be asked to move teams if they are experiencing hostility at work instead of that other person facing any sort of repercussions. And what this does is this ultimately sets back your career. You have to earn trust again on the new team that you switch to. You have to rebuild your expertise in that area, and that naturally sets back your opportunities for promotion.
I think Hannah's point is a key one as well. I mean, human resources is really there to protect the company in most cases, maybe all cases. So, having an organized workforce really helps to balance those scales quite a bit more. And, one of the other benefits of unionization is all the training that they do on health and safety. That's also why, going back to one of the earlier questions about full-time, part-time contingent workforce, it's really important to understand how many contractors a company has, because contractors can also pose health and safety risks to your directly employed individuals because they don't receive that same level of health and safety training. It's really incredible what unions do on a number of levels, but that's a huge one and certainly relevant for COVID-19.
I mean, just to bring that into operational reality, today, EasyJet are in the headlines because they're trying to reduce the number of pilots, and they've announced that they're going to use their health records, their sickness days over the last 12 months. And of course, there's great consternation now over this, and that's because the relationship between organisations and labour, whilst people are becoming incredibly material, and we absolutely recognize their value. There's still a long, long way to go in terms of transparency and data. But the more data we have, the more transparent firms become, the greater the scrutiny of their practice, and that can only be a good thing.
Okay, thank you. I'm going to go with two more questions from the board, and then we have a public comment request. So Ms. Oliveris and then Mr. Perez.
Thank you, Mr. President, and thank you to Anne and the panelists. Very, very interesting discussion, as others said, very timely. My questions are for Ms. Marchand. I think that during this time, especially in the investment space, there is a lot of overlap between the terms of racial justice, diversity and inclusion, and equity. Would you please explain how the NACD defines all three of those?
Absolutely. So when we talk about racial justice, we're applying really the stakeholder lens, that it's not, there's no one way to answer that question, that it only, thinking about racial justice only applies to a certain population. It's taking that broad lens of understanding the operating environment, that we were in an operating environment that didn't drop out of the sky, right? That this is something that has been developing over hundreds of years, and the racial injustices that we're seeing are things that actually impact customers, employees, suppliers, you name it. It's something that is we see as being hundreds of years in the making. And when we talk about racial injustice at the NACD, we've talked about it in a couple of ways. I mean, like I said earlier, we've talked about it in terms of economic participation. We've talked about it in terms of diversity and inclusion, which are related terms, and I'll get to that in a second. But where we see the overlap really gets to something that Cambria was mentioning earlier, that importance of having representation at the top levels of a company, in the C-suite, at the board level, in order to actually affect change. We've seen research that suggests, that having people of diverse backgrounds on the board actually makes room for diversity throughout the company. And so that's an important consideration. When we talk about diversity, specifically, we're talking about diversity in terms of in representation, not just representation in terms of tokenism, but thinking through how do you have the right people, the right voices at the table to bring to bear the experiences that help you govern an organization that has stakeholders who are from a variety of racial and demographic groups. When we talk about specifically inclusion, we're discussing how you specifically allow those varied voices to actually have power, not just to express themselves, but specifically to have power, so that when someone speaks in the boardroom, that we're not just listening to them to have a perspective presented, but that we're actually accepting that differing viewpoint in a way that allows us to take action. So it's a bit about board culture, really. So thinking through how you have a culture that allows for dissenting opinion and dissenting voice. So those are the ways that we use those three terms, if that was helpful.
It is, thank you. And then, sorry, there's two more parts to this. On being inclusive with gender identity, there's another board I've been working with, just volunteering and helping out, and they are moving away from gendered salutation, right? Because it's often binary and exclusive. And so there's MX that's been proposed, and some people say mix, some people say MEX. MEX might give a different connotation. Works for me, might not work for everybody else. What are you seeing with that?
That's a great question. So we haven't seen a lot of that. We think that part of the issue with neutralizing gender terms is that it's basically people want to have an easy way to remove the lens of gender from the conversation, versus the opposite is sort of what we're asking for folks to understand that, yes, this person brings a different perspective to the boardroom, and we want to see that experience. We don't want to ignore it. We want to see it, and we want to invite that the power of that experience to be part of the discussion. So I think it really depends on the specific board, but if we're to think through the power of diversity, it's not in ignoring the diversity that is there, right? It's in saying we see your experience, and we understand that you can bring that experience to bear in the boardroom, not in a way that makes you representative of that entire population, whether it be gender or race or whatever it might be, but saying we see that experience and we invite you to bring that into how we have discussions at the board level.
So then do you see that as a third option, or do you see rather than just using mix, for example?
We don't have a specific position on that at NACD, but I feel like it really depends on the board and what is healthy for that specific board.
You talked about the working with the SEC and the timeline. I worked with them since 2014 on trying to get some of this information included with the insurance industry. A little slow. What do you see the timeline as now?
Assuming is that a question to me?
Is that Camry? Might be something that Camry, I think you touched on.
Yeah, sure, absolutely. So I can only give you a best guess. I can't tell you for sure where I think the SEC is moving. They've moved actually relatively quickly on this issue based on prior experience. And so, as I mentioned, they put out the rulemaking for corporate reporting August last year. Comments have been coming in since then, and the SEC just released its Reg Flex agenda, and SK is on it, finalizing the rulemaking. Finalizing the rulemaking for SK is on it. So we might see something in a few months. It might not be included. There were also other disclosure areas that were included in that proposed rule. But my guess would be the next 3 to 6 months, but that is a very loose guess.
Okay, and the SEC with board inclusion, are we seeing anything else, especially when it comes to gender identity and sexuality? And this is for Ms. Marchand.
Okay, there we go. Can you hear me now?
Mm-hmm.
Yes.
Okay, can you rephrase the question one more time, please?
So the SEC was looking at board diversity when it comes to women of color, right, versus just like women, and then racism and ethnicity, and then gender identity and sexuality. Are you seeing any action there when it comes to them looking at board composition?
Specifically looking at intersectionality a little bit more, so it's not just looking at women. Yes, because we have seen, so we have seen a lot of, I'll leave it here and I'll say discussion around the importance of understanding that there hasn't been as much movement for women of color specifically. That obviously we have seen a lot of some movement in the boardroom in the past couple of years around gender diversity, but that hasn't played out as well specifically for Black women at the board level. So there is discussion. I know we've encouraged companies that there are obviously voluntary methods that they can adopt right now to try to push forward on gender diversity for specifically for women of color. We want to get ahead of anything that the SEC is doing, so we can actually say to boards, you have an opportunity now. If that's thinking through how you move board turnover a little bit faster. We know that's slow, obviously, but how you think about your turnover, whether there are opportunities for you even to temporarily expand the size of your board so that you can bring on women of color. There are various methods to doing that, but one of the other big pieces of that is obviously getting outside of your own network. So thinking through how we encourage boards to actually pull in, folks who are from firms that can actually help place board members that are outside of your network. But it is an issue. We know it exists, and we are pushing companies to be thoughtful about how they bring on not just women, but women of color.
Thank you.
Okay, yeah. Mr. Perez, hold on just a minute, because I inadvertently skipped over Ms. Taylor from my list. So then we'll call on you when I said two more. Ms. Taylor, please.
Thank you, Mr. President. I was like feeling all hurt for a minute there. I just want to, first of all, I want to thank Ann and staff for putting this together. This was an amazing presentation. I want to thank Ashley and Cambria and Hannah and Ant for their separate presentations. Hannah, I think what you talked about was very important. And I have a couple of questions here. Number one, how important, I know that your proxy proposal was about data, getting data. How important is it to also include and making sure that workers have a voice in that data? Because getting data from companies isn't necessarily the best way to go always, because you're not getting the full picture of what is actually going on with the workers unless we hear from workers. And so that's why I really congratulate staff for bringing you here and having a worker on the panel. So, but do you think that's something that your group, Discotech, would be thinking about in the future, is also including the, in the data request, workers' voices, workers, I don't know, surveys or something?
I think that's a really great idea. I think for this shareholder resolution, we wanted to make it very specific. And I know the SEC guidelines can be pretty strict, so we wanted to make sure that it was something that would be okay with an SEC guidelines, which I'm definitely not an expert on. But we wanted, because the employee voice isn't represented, we wanted to choose a metric that we thought the company couldn't really fake or get around what it might show. So that's why we chose rate of promotion. So how much time it takes for somebody to get from one level to the next, broken down by gender and race, because that really gets the company out of, they can't really blame the data on the pipeline, for example, saying that not enough women are going to school for tech roles and then feeding into the company and that sort of thing. We thought it really demonstrated how systemic sexism and racism might show up in your career growth. If it's possible under SEC guidelines to ask for actual employee data or employee surveys to be included, I think that would be really great. Discotech will be doing work around employee stories in the next coming months. So we at least will be asking employees about their real experience, but it would be great for every company to be held accountable to do that.
Great, thank you. Oh, go ahead.
Oh no, I'm just gonna piggyback off of that, and I think you touched on a huge challenge when it comes to disclosure from companies, is that if you don't make the disclosure request narrow enough and specific enough, especially when you're dealing with something that might be more qualitative, asking for a quantitative metric, you run the risk of getting bad reporting. Companies will report information that that is the most beneficial to them, makes them look the best. That's why we're looking for mandatory disclosure of certain data points. And that's also why, for example, turnover is a data point that everybody likes because it's a number. But along with that, you do need to have some more of that qualitative discussion about what those numbers mean. And so if investors can get a core set of metrics and then some additional metrics that are applicable to the company, you know, what are you guys requesting? Because that tells us something too. That's what you're prioritizing. Then we can start an engagement discussion with them and say, all right, let's dig in here a little bit more. And that's really what investors are doing with the information that we have. Albeit limited, but that's what we do on a number of data points now. So it is really it's a challenge because you do need to narrow the request in a way to get something meaningful, but at the same time, that's where those discussions go. Investors always want to know about employee engagement. That is one of the key asks all the time. The challenge with that information is that I'm asking a company to report on the engagement score that they've developed using their own questionnaire that might have changed from last year. So really, again, that's where the engagement piece comes in, and it's part of our responsible ownership as well.
Okay.
And at least...
Okay.
I'm not done, Henry.
Oh, okay, go ahead.
And go ahead.
I was going to say, at least at Amazon, they do annual surveys about employee happiness and that sort of thing. And the whole company does get to see the results. So you can look at a manager's results and see how happy people were under them. But since representation of women and underrepresented minorities in tech is so low, it's really hard to understand what that data actually means without the data being presented broken down by these different demographics. Because if the majority of the workforce is men and they all say that they're doing great, then is white men, then it just fudges the data.
Great, yeah, no, and I agree, and that's kind of why I get that we have to be pretty narrow in our asks, but I think it's always important to have a worker voice, especially when it's systemic throughout, and whether we're talking about systemic racism or discrimination based on sex, sexual orientation. If you're not, these surveys aren't meant to kind of pull that information out. So somehow or another, to get a voice on these, I don't know, words or metrics somehow or another, I think is really important. But I did want to again thank Ashley and Cambria and Hannah and our staff for putting on a wonderful presentation. And I want to echo Ms. Yee and Mr. Rufino's comments, Mr. Rubalcaba, that we know, we've been hearing, we've been seeing it in the news, the systemic risk that has just become apparent during the pandemic when it comes to workers, whether it's workers not having enough PPE or not being safe at work, and then the whole workforce getting sick and not having sick leave and not having the ability to call off because they don't make enough money and they don't have sick leave. And I think as we reopen and we're looking at our custodians and our security guards and then all the fast food that's been open, Amazon warehouses, wherever, we need to continue this work. And I'm asking staff to lead us in managing this risk, because I think, number one, managing this risk is also having workers tell us what's going on, but also, number two, like you are doing and with the SEC, making sure that it's included in reporting requirements. And I think we owe congratulations to Anne and Human Capital Management Coalition for getting the SEC to go along with these rules and start defining what we can about frontline workers, essential workers, you know, pay-wise, sick leave, et cetera. So again, I thank you. This was an amazing presentation. All of you, thank you very much.
Okay, Mr. Perez.
So this maybe is directed towards Anne. I believe in diversity, but I'm more concerned in diversity of thought when it comes to a boardroom. So how, in our advocacy for diversity, how do we safeguard not exchanging, how do we safeguard against lowering the efficiency of a board and the diversity of thought by increasing the number of whatever you want to add to the board, whether it be color or gender?
Thank you, Mr. Perez. This is a really important question. And CalPER's definition on diversity is multifaceted. We, the board, and I don't think the staff would argue that we would approach this from the point of view of a quota. For that reason, we haven't participated in some groups which have taken a quota approach, a certain percentage for a certain category, because at the end of the day, what a board needs is the best talent for the job that that company is having to do. So the way that we're approaching diversity and inclusion is you open up the pool of talent to make sure that you've got the board independence, the board quality, and diversity of thought is what's going to help you not just capture talent, but also we see benefits in risk management as well. Because people who think differently, with different backgrounds, bring a different perspective on risk. And there's some interesting research on that topic as well. So to respond in summary, the quota approach has been taken in some countries like Norway, like France, but I certainly think from an investor, from a fiduciary point of view, we're talking about talent and we're talking about diversity of perspectives for the purposes of that risk and return that we need to focus on as fiduciaries. Thank you.
Okay. Okay, thank you very much. And again, I won't repeat what my colleagues have said about thanking you very much for this presentation. But we do have, I know of one request so far from the public to speak. Mr. Kelly, is that person available to make those public comments?
Yes, Mr. Chairman, we have 3 callers. Our first caller is Mr. Michael Ring from SEIU.
And let me remind the members of the public that we will allow 3 minutes for public comments. Okay, continue.
Hi, this is Michael. You can hear me?
Yes.
Great. This is Michael Ring with Service Employees International Union's Capital Stewardship Program. I want to thank the Investment Committee and all the speakers for laying out critical fiduciary issues related to workforce risk today. I'd also like to thank Mr. Jones and Ms. Taylor for their thoughtful and timely comments at last month's board meeting, which I believe are very relevant to today's discussion. SEIU firmly supports CalPERS' history of proactively managing workforce issues. We believe CalPERS' leadership in this area has helped the fund mitigate risk and sustain value across the portfolio over the long term. But as this panel's presentation indicates, this work is only more important now. It is clear that as key financial market stakeholders, which include regional Federal Reserve presidents and the heads of major corporations have recently stated, that long-term investors will not succeed in their fiduciary duty without proactively addressing structural racism. It is also clear that the COVID-19 public health crisis brings direct risk to investment returns. We believe fiduciaries must take proactive steps to encourage companies and investment partners to adjust their business models to address these 2 risks and protect their investments. Unfortunately, relevant examples abound, but I'll stick to 3 data points for today. Number 1, at major retail food chain restaurants, we've seen COVID outbreaks that lead workers to walk off the job in several places here in the state of California due to the lack of protections in unsafe work environments. And to state the obvious, this threatens business. In the nursing home world, there are thousands of residents and many workers who have died during the pandemic. This also obviously threatens business. Finally, I want to share a tragic data point, which is that SEIU's largest property service local, 32BJ, which represents many workers across the East Coast, has tragically had 133, that's correct, 133 of our members die. These are cleaners, security offers, and other essential workers. They've lost their lives to COVID. This is not an acceptable outcome, and of course, it also threatens business. SEIU President Mary Kay Henry recently wrote to 15 of the largest real estate firms in the country to invite all stakeholders in commercial real estate to work together towards solutions. As Ms. Yee referenced, this is critical to the value of commercial real estate properties going forward. In each of these industries spread across investment portfolios with private and public market exposures, a disproportionate number of workers at risk are people of color. And these examples to us make clear that long-term investors need to address structural racism, all forms of workplace discrimination and harassment, and worker safety to protect their investments and successfully meet their fiduciary responsibilities to plan participants. SAU thanks CalPERS for putting together this panel today and for its continued leadership in this area. It is a critical effort in CalPERS' mission to deliver retirement benefits to plan participants. Thank you.
Thank you, Mr. Ring. Mr. Fox?
Yes, Mr. Chair. The next caller are 2 callers on the phone call from Unite Here, Alejandro Rayburn and Juanita Amico.
Hello, can you hear me?
Yes.
Hello, my name is Alejandro Rayburn, and I'm a researcher with Unite Here, the Hospitality Workers Union. And I'm here to talk about how one of our union's largest employers, Ambridge Hospitality, how their actions during the current healthcare crisis are causing a negative value for CalPERS investment. I'm also joined by Juanita Galipo, a banquets worker at the Santa Rosa Hyatt, an Ambridge operated hotel. CalPERS is a part owner of Ambridge Hospitality through their investment of $500 million into Advent International's Global Private Equity Fund 8. Ambridge adopted a low-road human capital management strategy in response to the COVID-19 pandemic by laying off and terminating healthcare benefits for most of its workforce. Ambridge's cost-cutting jeopardizes the health of its employees and California communities and puts CalPERS investment at risk by undermining the ability of the workforce to deliver quality hospitality and a healthy, safe, and speedy reopening. Ambridge must commit to a safe reopening and extend healthcare and recall rights for its workforce. Juanita will describe problems at her Ambridge-operated hotel. Juanita?
Hello.
Hello.
My name is Juanita Galipo. Can you hear me?
Yes.
I work at the Hyatt Santa Rosa for over 16 years in banquets. My decision to speak today is due to the fact that we're living through a pandemic, and it's imperative to have health care. Most of us are laid off right now. Out of 80 workers, 4 people are working in housekeeping, and few are working in front desk and maintenance. We need employees to keep providing health insurance. They have started paying insurance for most of my coworkers who are laid off, and the ones who are working, some of them don't qualify. Imagine facing the public right now without health insurance. Now, most of my coworkers are having to choose between rent or paying the full cost of health insurance. Many will be forced to choose keeping a roof over their heads without health insurance. Some people, many, will keep quiet if they have symptoms of the COVID-19 because they can afford to pay for the care. That is bad for everyone because that's how the disease spreads, the virus spreads. I hear that housekeeping is getting overworked. The new manager that just arrived from Innovation, the housekeepers cleaning the rooms, 14 rooms, only checked out, which is way harder and more dangerous because the rooms get so dirty and with the heat, everything is sticky. They have glass doors in the bathrooms, which is hard to clean, especially after a few days. They might not be able to clean it perfectly. Already one housekeeper with over 10 years of experience working there had to quit because of the work overload. I leave it up to your conscience to do what is right. Our future is yours too. We have the expertise to do this work right, but we need to stay healthy and safe. We all own part of this pandemic. So please, we need health insurance to keep going. Thank you so much for listening.
Okay, thank you. Mr. Fox?
Mr. Chair, we have one last caller on this subject, Mr. Tim Behrens from the California State Retirees.
Good morning, President Jones.
We lost him. Mr. Kelly, we lost him. Mr. Fox, I'm sorry.
Yes, Mr. Chair. Hopefully we can get him to call back in.
Okay.
Mr. Chair, it appears that he is calling back in, so it'll just be momentarily. We'll get him back on.
Okay, thank you.
Tim Behrens, Timbehrens.
Go ahead, Tim.
You're on, Tim.
Okay, thank you. Tim Behrens, the president of the California State Retirees, and it's a question for the panel, which I found all of your information to be very enlightening. One of the terms used by several panelists was racial injustices, and I wondered if your data includes a large Hispanic and Asian population of the workers in the United States. Thank you.
Okay, well, Ms. Simpson, we'll ask you to get an answer to Mr. Behrens on that question. So, okay, all right, thank you. So at this time, we're going to take a break and we will reconvene at 11 o'clock. So we will see you all at that time. And thank you again, panelists, for your participation and your comments and input.